Let's take a look at credit markets now, with the beginning of the year strongly, with global bond market issuance benefiting from surging demand and tighter spreads. But what's the way forward, particularly given what central banks are likely to do this year? Frank Donnelly joining us from MA Financial. Frank, good to see you.
Good to be here.
The big question as to central bank movements. But first off, set us up with what you're seeing there, just in terms of, I mentioned that global bond issuance. What are we seeing at the moment?
Yeah, we're really seeing a record issuance start to the year globally in bond markets. In fact, if you look globally, in January we saw about 189 billion US dollars of bond issuance, which was a January record, and it looks so far like February might be on track to exceed the 150 billion US dollar record that was set last year. So yet another level of record issuance, but 2 months back to back. So there's clearly a lot of demand for bonds from investors, and really what I think is going on is that there was money sitting on the sidelines last year, and it's being deployed. It's being deployed very quickly
Into bonds rather than equities?
Yeah, into bonds, into credit generally. Certainly into bonds. We're seeing that both in corporate bonds globally. There's not a lot of corporate bond issuance in Australia, of course, but globally in corporates, and then broadly across financial sectors. Yeah.
Is that sustainable? I guess the question, isn't it, given that central banks are likely to be entering an easing cycle sometime this year?
Yeah, it's really funny. I think what's going on is that there is a huge amount of money now which is passive, and you're seeing these wild sentiment risk on, risk off trades. At the moment, there's a risk on trade. Of course, you're seeing it in equities, but you're also seeing it in parts of the public traded credit markets like bonds. We're seeing that at the moment. Right now, spreads, if you think about financial spreads, about globally, again, about 115 basis points over benchmark rates, and for corporate high-grade issuance, it's 127 over base rates. I mean, these are pretty narrow spreads, I think, actually, for the risk that you're taking, and as a lender, being exposed to these kind of assets and the volatility that you're taking, the all-in yield looks pretty attractive, but that's just a function that base rates are high.
What are we seeing specifically in Australia? Obviously, you mentioned corporate issuance is minimal. Globally, you compare globally at least. Moreover, how would you characterise what we're seeing in Australia?
Yeah, well, the parts of the Australian bond market that are issuing are seeing the same dynamics. So if you think about the securitisation market in Australia, for example, there's a lot of issuance taking place at the moment, and these deals are being significantly oversubscribed. We're seeing some tranches oversubscribed 5 to 8 times, including in some of the lower rated sub-investment grades, so the high yield tranches, and the spreads there really compressing as well. So you're seeing the same dynamic at play in Australia, which is, I think, again, just that risk on trade is flowing into not only equities, it's also flowing into credit. And I think it means that investors need to be thinking about where they're positioning in this dynamic, because of course in bonds you do get the benefit of liquidity, you can trade them, but you've got to make sure that the return is actually commensurate for the risk. Interestingly, the best time to buy bonds was probably 12 or 18 months ago, when there wasn't as much demand, particularly in parts of the market, again, like securitization, where sort of demand had gone away. Now demand's back, it's hot, it may not be as attractive.
So in terms of private credit, what are you seeing there at the moment? And I know you're perhaps going to cite an example there of what we're seeing from KKR, for instance.
Yeah, I mean, look, just recently we did see a group of lenders led by KKR lead what's about a $2.8 billion facility for Clarence Technologies' acquisition of SafeFleet. Again, globally, that's a 7-year deal. It's 575 over base rates. Now, think about what that means. At 575 over base rates, where that was issued, at the 98-cent price, that's about an all-in return of 11.4. So I think you've got to think about really the true fundamental risk that you're taking in all these positions, and what the all-in return is and how attractive that looks, rather than just I guess the aggregate level of return if you're comparing kind of bonds and private credit. That deal's a good example, but there's many of them where you're seeing private credit lenders now step in and do what the bond market used to be able to do, or at least the leverage loan traded market globally was able to do, which is take down these larger transactions, and it's now being done more quickly, more efficiently in a private market sense. That, I think, remains an attractive dynamic, but private credit's still a broad church, and you have to make sure you're positioning in the right part of the market where the risk return remains attractive and there's not too much hot money.
What are the bigger risks you see, on a global level at least, presenting themselves this year with, well, I guess the ever-present crises being, potentially regional banking in the States, and also, of course, what we're seeing in China with the property market?
Yeah, look, I mean, banks globally do have a lot of exposure to various types of commercial real estate assets, non-residential, I should say, commercial real estate assets, which are facing a lot of headwinds, challenges. The work from home dynamic persists, and so the valuation of office buildings and so on has come off significantly. Is that a canary in the coal mine for banks globally? Look, the losses in that space look like they're going to be concentrated in the banking system. It's quite an interesting dynamic because we talk a lot about, are there risks in private markets or shadow banking and so on, but actually here there's quite a bit of risk that's actually concentrated in the banking landscape. It tends to be at the smaller banks, so a lot of those, as you say, more regional banks in the United States and globally that have these exposures. I think there are some real risks there. I wouldn't go so far as saying that it's systemic. I do think that post-financial crisis, the banking system has become well capitalized, but there are going to be segments like that do face some headwinds. I also think there's going to be parts of the market that are consumer exposed, where as these higher interest rates, stay here for longer, if we don't see some, rapid rate cuts in short order, consumers are going to have to change their behaviour, and there'll be parts of the market like that which I think will continue to face some cyclical pressures, and that will flow through the financial sector.
Well, how wary should we be though? When you cite obviously those property devaluations we're seeing, here and elsewhere, has that all sort of been priced in? Is the worst yet to come, do you think?
Yeah, I'm personally not sure, but that said, I've been reasonably concerned about a range of risks in the economy which haven't materialised. So I guess I just caveat my views on that basis. I think that it is a time to make sure that you're really focused on the capital preservation and the downside protection in your portfolio, have the right level of defensive assets, and make sure that you're positioned to capitalise on opportunities when they do emerge, because it has been quite a while now since we have had a true economic decline. We've been having recessions every 4 to 6 years since the beginning of time, really, and it's been quite a long time since the last one. So I think it's worthwhile being defensively positioned, but if you can get a nice return, a nice risk-adjusted return while you do that, that's probably the place to be, and then be ready to be opportunistic when you can.
And Frank, given where interest rates are likely to go this year, with the prospect of rate cuts beginning sometime this year, what are we seeing in terms of investors opting for fixed or floating rates?
Yeah, we are starting to see more demand from investors for some ability to lock in rates. Now, most credit funds that we like to run are generally floating rate. We don't like to make macro bets, and because we don't have a crystal ball on exactly when interest rates will move, but there are ways to lock this in, and I think investors are starting to look at that. Now, you can also do that by just thinking about, what is an appropriate level of return you want to earn over the benchmark rate in a floating rate product. But look, we're starting to see that dynamic flow through, and I think there's probably more to come there that you'll see from the investor base broadly.